We are going to do problem 10.7. Has no hedging, so I just wanted to give you practice with that. You guys, I'm not sure that it's clear. Maybe with the light off, it's clear. It's hard to tell you guys. Sorry about that, but you're going to have to let me know which is better. This one, I hope, doesn't cut off the sound as much. I listened to a bit of it. It cuts off right at the beginning. But I think it just takes a sec to get through. So anyhow, but it also does it in a whole piece. So you can let me know which camera you prefer for me to record from. Okay. Problem 10.7. Hamilton Importing Corp imports goods from countries around the world for sale in Canada. They purchased on December 1st, year 3, purchased 11,300 watches from a foreign wholesaler for DM 613. Now, interestingly, I looked up DM 613 and my immediate thought was Deutschmarks because I'm old. And that was the currency that first West Germany used and then all of Germany when they united. But since they joined the European Union, it hasn't been used. So I wasn't sure if they were talking about Deutschmarks or DM cryptocurrency, which I'm guessing not because it's relatively new and this book is in its last cycle of 3 years. So we can just pretend whatever currency it is. Notice foreign wholesaler, they weren't specific. So I'm just going to call it Deutschmarks, but be aware that Germany hasn't used that for a while. Of course, in union like the UK did, then that could be a whole different thing. Anyway, so they import goods, they purchased. Now notice they purchased, it's past tense. With these questions, you guys, it's not 100% clear whether they actually have recorded a transaction or haven't. The consistency is if they use past, like sold or purchased, that means they did and you can record the transaction. But if they didn't, it'll say signed a contract or will be receiving. They're more vague. So this is not a contract. And record now. Because it's a past tense. It's the word purchase. Okay, so they bought that. The invoice was going to be paid April 1st, year 4. December 3rd, they entered into a forward contract with a bank at a forward rate of 0.794. Hedge accounting is not applied. So we're doing all the transactions. It's like you took the first and the third example of your, maybe it's not the third, just wait, give me a sec to look this up. If you took example 1, they put them together. Okay, so trend is December 31st. Of course it is. Spot rate is 0.770. 90-day forward rate is 0.799. Payment to supplier was made when the spot rate was 0.816. So looking at the requires, we're going to record the journal entries in year 3 and 4. Hedge accounting is not applied. And we're going to prepare a partial statement. We don't care about C. D just adds confusion. So right here, segregated between spot element and forward element. What it actually does is separate out the change between the two. It gets a little messy. You use something called hedge expense, and you do not need to know that for this course. So we're just going to take that baby right out, and we don't care about summarizing all the journal entries. Okay? So we're just going to do A and B. So the key thing I said is we have to do what? Get our little diagrams correct. So here we are, Hamilton Importing Corp. And here's our foreign company. Now, we are importing goods, so we're purchasing watches. So what's coming to us is inventory, and what's going to them is 613,000 DMs. Then we have our forward contract. And a Forex or a bank or whoever it says, in this case, they didn't say. Just say, entered into a forward contract. Oh, in this case, this is the Royal Bank. Sorry, I should have read first. So, entered into forward contract with the Royal Bank, and that's all it says. So, way is it going now? Well, remember, we hedge the opposite. So if we're giving away DMs, we will be getting DMs from the bank, and we're going to give them Canadian. And remember, the Canadian is always the spot rate on the date of forward contract. Date forward contract signed. Let's put that. So always do this and double check you've got it right. Then you can go on and do the entries. So let's go ahead and do the entries. And there is no hedge accounting. December 1st. Now, we did have a purchase. So we can record it. Debit inventory and credit accounts payable. And it's going to be in DMs. Now, remember, we're writing everything in Canadian dollars, but that's just to remind your brain which way things are flowing. Okay, so we take 613 times the spot rate on the date. So if we look up here, the spot rate on the date of purchase should be 0.754. Right there, up here. 0.754. 754, and that works out to 462,202. Now the forward contract, no entry. Remember, we're and when the payable and the receivable equal each other, we do not adjust it. Now it's December 31st, which is our year end. To adjust our purchase. So we adjust our purchase. Now I'm just going to draw the little rates over here. Remember, we use the spot rates. And we started with 0.754. And then we went to Fiscal end of December 31st, the spot rate was 0.770. So 0.770. So what happened to the Deutschmark? Went up or down? It went up. And are we giving or getting? Entry. Giving. So are we happy that the price just went up? And if you have to think of it, you're giving away pens. Well, the price of pen just went up. Are you happy? No, now you got to pay more, so you've got a loss. So you're unhappy, so it's a loss. So we are going to debit loss on exchange, credit the accounts payable. For 613,000 times 0.770 minus 0.754, which works out to 9808. Okay, what else do we have to adjust? The forward contract. So we're going to adjust the forward contract. Now, you guys, you could have actually done all of the purchase first, then all of the forward contract, just like examples 1 and 3. Okay, just make sure you put the right dates on them. But this is how it would actually flow through together. Okay, so let's do the forward rates. So we started with the first forward rate, entered into a forward contract at a rate of, whoops, sorry about that. The forward contract with the Royal Bank of 0.794. So 0.794. On December 31st, the forward rate was 0.799. 0.799. So we are getting or giving. So we go back to our little chart. Remember to use the right chart. Forward contract, we're getting them. So we're getting a pile of pens. Go up or down? They went up. And we're getting them. So the pens we just got all just appreciated. Are we happy? Yeah. So we're happy. It's a gain. And remember, we are getting DM. Always they have to be the opposite, you guys, but they have to be the opposite in the correct ways. So this setup is the critical part. Okay, that shows you understand what's happening. And then this shows that you understand which way the currency is going. Okay. Okay, so let's adjust our forward contract. We know it's a gain. So we debit forward contract, credit gain on exchange. And it is 613,000 times 0.799. Oops, I missed the 7. Minus 0.794. So 3065. Now we've got to settle the contract. Now, you notice something here. Payment's going to be made on April 1st for our purchase. Now, they didn't actually give us an ending date for the forward contract. They just said 120-day forward rate. I don't expect you, sorry guys, it says 120-day forward rate. I don't expect you guys to figure out the ending date. When they don't tell it to you, it's going to be the same date. okay? Because that's when you need the money or that's when you're getting the money. So you can assume it's the same. Just so you know, in Excel, in case you wanted to, if we knew if this was a leap year or not, because we don't, you could put in December 1st, year whatever, and then put the whole thing as a date into a cell, and then in another cell put equals that cell plus 120, and it'll give you the actual date. I think this is a leap year because I went for 2021, which going to 2022 isn't, I don't think, and I was short a day. But anyway, that's an aside. That's something you can try in Excel for fun. Just did our forward contract. Now we're going to skip over, keep this handy, and go to the settlement. Year 4. Is settlement. The sale or the purchase first. So first thing we're going to do is settle the purchase. It absolutely does not matter what order you do it in. Do whatever works for you. So I'm going to adjust accounts payable to fair value first. So we need to go back and look at our little rates. And December 31st, the spot rate was 0.770. And when they paid, it was 0.816. So the spot rate started off at 0.770, and now it's 0.816. So DM went up, and we are giving DMs away because we bought something. So is this good for us? No, we're unhappy. It's a loss. So we debit loss on exchange and credit AP in Deutschmarks or DM cryptocurrency 0.816 minus 0.770. 198. Loss. So now we can actually pay for the inventory. Yeah, I lied. You have to do the adjustment first, then the inventory. What I meant is you could settle the forward contract first, then settle the purchase. It doesn't matter what order you do those two things in. Pay for inventory. So we're going to close off accounts payable and we're going to pay cash. We know that. What's sitting in accounts payable? So way back on December 1st, we have a credit of 462,202. Then at year end, we had a loss, so 9808, and had another loss of 28,198. So the total there is 500,208. Now again, you guys, you don't have to show all this, but I'm doing it so when you look at your notes later, it'll make sense to you. So we can put that amount in 500. That's from the T account. Now, obviously, they should be the same, but that's what I kind of wanted to show you. So cash, we pay the cash, use the spot rate on the date of payment. So we already know on the date of payment, the spot rate is 0.816. times 613,000, and that is 500,208. Check that you didn't accidentally record a gain when you should have recorded a loss, or mix something else up. So the fact that they both balance, one from a calculation and one from getting your gains and losses right, is a good thing. So that's one way you can double check what you're doing. Now we can settle the forward contract. Could have done this all in one. Okay. And the AP would have been lower, but you would have had the loss to balance it. So you could combine these if you wanted. For a contract. First thing we're going to do always, you guys adjust. So adjust forward contract to fair value. So we need the forward contract rates from the last time we made an entry, which was December. So last year, last day of, oh my God, December 31st, the fiscal year end, 90-day forward rate was 0.799. And now we need the forward rate at closing or at settlement. Well, it doesn't tell us. It only tells us the spot rate. So what are we going to do? What is the same on the very last day? Closing and spot rate. So we can use this. It's also the forward rate. This is a good example where you're missing a little bit of information. One, they didn't tell you which way the forward contract was going. You had to figure it out from your drawings. And two, they didn't tell you the last forward rate. Plus, I always find the questions where they mix up the rates in the text a little harder to understand than if they put a table out. So the forward rate was 0.799. Now it is 0.816, and let's put a little note, same as spot. And DM went up. We are getting M. So are we happy? Yeah, so it's going to be a gain. So to debit forward contract, asset in this case, and credit gain on exchange. 13,000 times 0.816 minus 0.799, and that works out to 10,421. So now let's see what's in our forward contract, a little T account. And again, this is just so you understand where things are coming and where they're going. So from our December 31st entry, because December 1st, the purchase, there was no entry. So we look down here, we have forward contract debit of 3065. So 3065. Then we had a debit of 10,421. Out to 13,486. So, yeah, double check you can do when you're doing your statements or your entries, I'm sorry. Okay, so to settle the forward contract, so we know we are giving away Canadian. So cash are we giving away? Let's do giving away. Well, remember we said you always do it based on the time you signed the contract. So looking back here, signed the forward contract at 0.794. Okay, so that's always the original rate for the Canadian. So 0.794 times 613,000, which is 486,722. Now, how many DMs do we get? Well, the forward contract rate on the date of settlement, so 613 times 0.816. And notice this is date of settlement, and this is original. To 500, 208. So we're missing a credit. We hope it's 13,486, and it is. Again, this is kind of a double little check in case you misclassified one of your gains or losses. Made sense? You guys, if you have any questions, just email me, please. Oh, now let's do the balance sheet in part B. And I'm adding in the income statement, okay? So, part B, the December 31st, year 3 balance sheet. And I also want the income statement for year 3, just relating to this. So, look at your entries on December 31st. And you'll notice you have two things that belong on the balance sheet. You've got an accounts payable, which carries over from December 1st. So this accounts payable carries over. You also have a forward contract. So is this contract, because this is the only entry we've made, is it an asset or a liability? It's an asset for part B because it's got a debit balance. So assets and liabilities, and they're going to be one in each. So our asset, we have the accounts payable. The forward contract. My God, yes. Yes, accounts payable is an asset. No, it's not. It's a liability. The forward contract balance was 3,065 because there was only one entry. And liability was accounts payable, and its balance was 472,010, which is just the 462,202 plus 98,08. Now, if we look at the income statement, then we're talking about gains and losses, right? So, again, it's December 31st. We don't have much to go on. We've got a loss on exchange, and we've got a gain on exchange. So, we've got a loss from our inventory of 9808, gain of 3065, and that's our forward contract. So overall, we have a loss $6,743. Okay. The reason they're not the same is because one is using a spot rate, one is using a forward rate. The forward rates are fixed, so you're betting months in advance, days in advance. Not betting, but signing days in advance. Whereas the spot rate is certain, right? So there's uncertainty built into the forward rates. So they are not the same as the spot rates. And in fact, sometimes they can go in different directions, okay? Because one builds in forward information. That's what I wanted to do for problem 10.7. So hopefully that made sense. If not, just let me know. And I will close this off, and then we'll come back and I'll do the final little recording of the multiple choice question.